for the speaking as he joins. Please go ahead.
Sure, sir, sure. A very good morning and good afternoon to all of you. My name is Sumedha Kanwar and I will be the anchor for today's session. On behalf of everyone at the Indian Gas Exchange, I would like to welcome all of you today to the IGNITE webinar titled India Energy Dialogue on Gas Market, International Experience. Before we proceed, I would like to request everyone who isn't speaking to kindly mute your mics. Thank you. Now, without any further ado, let's begin this session by introducing our panel. We have industry leaders like Mr. Baptiste Dubreuil, Senior Gas Analyst, IEA, Dr. Egbert Laege, former CEO, EEX Asia, and Ms. Ilaria Conti, Head of Gas, FSR. Thank you, dear speakers, for being part of this edition of IGNITE. Please note that we have allocated some time for a Q&A session at the end of this program, and it would be appreciated if you could reserve your queries for then. I would now like to call upon Shri Rajesh Kumar Mendiratha, Managing Director and CEO, IGX Limited, to open this session. So over to you.
Thank you, Sumedha, and good afternoon, everyone. Sorry for technical glitch which we are experiencing now, particularly with the connection of Mr. Kapoor. So we are trying to resolve it, and probably as soon as that glitch is over, he will be able to join. So meanwhile, I'll commence this program, open this program, and it gives me a lot of pleasure to welcome you to this IGNITE, our energy talk event. I'm honored to extend a warm welcome to our Shri Tarun Kapoor ji, former Secretary, Ministry of Petroleum and Natural Gas, who is our esteemed chief guest today. Thank you, Mr. Kapoor, for joining. I would also like to welcome our eminent speakers, Mr. Baptiste Dubreuil, Senior Gas Analyst, IEA, International Energy Agency, Dr. Egbert Laege, former CEO and member of EPEX board and former CEO, EEX Asia, and Mrs. Ilaria Conti, Head of Gas, Florence School of Regulation, who are all highly respected in their respective areas of expertise. And many thanks to Mr. Anish, my good friend, partner, KPMG, for taking up the mantle for moderating this panel discussion. I'm really happy to have such a great panel of experts today with us, having very rich experience. Mr. Dubreuil from International Energy Agency, having brought the overview of the whole international scenario. Dr. Egbert, having worked with PowerNext, the first power spot gas exchange in Europe, and one of the most liquid one. And later he was part of EEX, now part of advisory board of several exchanges. Mrs. Ilaria, who is from Florence School of Regulation, leading the gas practice in that school, that is the leading school in Europe. And of course, on top of that, we have Mr. Anish, Head of Energy Practice and true master in the subject. And also Mr. Kapoor, who has got great experience in power, and recent past, he also steered the Petroleum and Gas Ministry at the helm of government. So our government's vision for gas sector is today to attain gas consumption in primary energy mix from current 6% to 15% by 2030. We understand that for any sector to grow, particularly energy, needs focused reforms and changes, at least in three broad areas. So one is infrastructure, second is legislative changes, and third one is markets and pricing. Government has taken prudently steps for improving infrastructure. Already a lot of work has already been done. They are adding new network capacity, adding new LNG infrastructure, doing everything for increasing domestic gas production on supply side, and expansion of gas demand by giving new CGD licenses. So far, we have almost assigned licenses for almost 90% of the population in the country. So now we need to focus more on putting enablers in place so as to create real competitive environment to push demand and investments in supply both. As we see today, gas markets play a key role in establishing a mechanism for right pricing so that resources flow optimally to respective sectors and also attract investments in the sector. The price signals reflect demand supply within the system, and it allows producers and consumers greater freedom to sell and purchase this gaseous fuel based on demand-supply dynamics. And therefore, for developing well-functioning gas markets, we need to look and learn from matured gas markets around the world and understand how challenges unique to their native market conditions were addressed during their evolution into liberalized gas markets. In this context, the evolution of internal gas market of European Union, starting from individual national gas markets with highly heterogeneous market and regulatory structure into highly competitive, liberalized and homogeneous gas market, while simultaneously allowing each European Union nation with flexibility. And therefore, Europe serves as a widely recognized and most researched liberalized gas market model. Very briefly, if we look at the evolution of gas markets in Europe, nearly 25 years ago in 1988, the first of the several legislative steps were taken to open European gas markets to introduce competition in the natural gas sector. Three basic regulatory principles, as we know, were embraced in Europe to create a well-functioning gas market. Firstly, non-discriminatory access for trading parties to these essential activities. Second was provision of unbundling of marketing and trading and transport. And then, of course, supervision and control by system operator, and then rationalizing the transmission pricing. While preliminary attempts were made in the early 90s, the gas regulatory framework was implemented over the years with three consecutive gas directives spaced out over one decade from late 90s to 2010. And European Commission provided increasingly explicit rules to be implemented by member states in European countries, making the markets competitive and seamless. In today's session on international gas markets with our eminent panelists, I'm sure we will have a lot of takeaway and learning from their respective regional experiences. Before we go on to today's agenda, I will just like to brief on where we are as exchange today. We started in 2020 and started operating as authorized gas exchange in December 20. We are just over a year old. We run physical contracts for spot that is dared and also forwards up to 3 months ahead. And we have fortnight, weekly and all these contracts available. And we also facilitate financial settlement and delivery, which is optional for all contracts. We at IGX have designated 5 physical hubs. The Dahej hub is emerging as most liquid hub. As exchange, we have covered few milestones, about 65 plus participants, touching volumes of 500 million cubic meter a month, which is about 1% of India's gas consumption in the country. And first time we are setting price benchmarks for Indian stakeholders. We will shortly see the sale of market freedom domestic gas, which will be happening first time outside the regulated mechanism. We also have vision to set credible Indian price benchmark. So with that, we hope that we should be able to someday set a very robust benchmark to allow financial markets to operate over the spot markets. So with this brief IGX update and positive note, I conclude here and invite our MC Sumedha for proceeding further, inviting Shri Kapoor ji. I am told that he is able to join, followed by a discussion with our expert panelists on their deep insights on the international gas markets and learning for us. So once again, many thanks and welcome to each and every one of you for making it here today. Thanks.
Thank you, Shri Rajesh Kumar Mendiratta. Moving on to the next part of the program, we're glad to share that we have our esteemed chief guest, Shri Tarun Kapoor, with us to address this gathering. He needs no introduction at all. Shri Kapoorji was former secretary and has been helming the affairs of the Ministry of Petroleum and Natural Gas in India. Over to you, sir. Sir, we can't hear you. There's no audio.
Sorry.
Okay. So good afternoon, and thank you to all to the organizers for inviting me here and for organizing this discussion on such an important topic at the right appropriate time. India is now very fast moving towards a change in the way we use our energy, the big change from pure fossil fuels to cleaner forms of energy. There are big announcements which the country has made. Honorable Prime Minister has been talking about energy transition and change which the country has to go through. And gas, natural gas has to be the transition fuel that we are very clear about. Now, if natural gas has to be the transition fuel, then gas has to be freely available. It should be marketed. The consumers should be able to get the gas when they want, in quantities, what they want, at price which is competitive. The sellers of gas, be it domestic producers or international traders or importers, should also be able to sell their gas, and they should be able to sell quantities, right quantities, so that there is no wastage, and we have a very optimum kind of, or a very ideal kind of a situation in the country. So in order to open the gas market, there are a few requirements. First requirement is we must have infrastructure in place, which means that we must have pipelines so that gas can be transported to from where it is brought. If it is imported, then from the terminals where it lands to the consumer's end, or if it is a domestic production, then again from the point from where it enters the grid, the gas grid, or right up to the point where the consumer wants it. And the consumer, or those who want to sell and buy gas, then they should have full freedom to buy the pipeline capacity for transporting their gas. So that is one part. The other part is that we must have policies, guidelines, and regulations in place so that people are able to trade freely in gas, to be able to sell gas, to be able to buy gas, and to be able to book this transportation space. And the third requirement is we must have a platform where this exchange or trading of gas can take place, and that's why the gas exchange becomes very important. So in India, while large quantities of gas are under some long-term contracts, there are contracts which GAIL has, there are contracts which PLL has to import gas or LNG on a long-term basis. These contracts are linked to oil indices, and then there is some spot purchase also taking place in international market. And on the other side, we have domestic gas. For sale of domestic gas, we have given some guidelines where the domestic producers can sell in a transparent manner, and they have to go through a bidding process. But for all this, we also said that they can buy and sell through the exchange. And exchange is probably the best mechanism for determining the price within the country. So while there are international indices for determining price of gas, and also, as I said, some of the long-term contracts are not linked to the gas price index, they're linked to the oil price index. But then we also must develop a benchmark or an index which is specific to India. So we have the Indian West Coast, which is coming up as one index, not fully recognized yet. But then through the exchange, also we can have a situation where at least the price gets determined on a regular basis, and we have at least the buyers and sellers would know what the market looks like and what they can expect. In the past, what we've seen is that the large consumers of gas, the large consumers of gas are uh, the city gas distribution companies who have contracts to distribute gas in various areas, which have been already given out through PNGRB. Then we have the power sector, where we have installed capacity of over 20,000 megawatts, but a lot of it is not being used on a regular basis. And then we have the refineries, and then we have the fertilizer companies. So these could be classified as the large consumers of gas. So and then there will be so many small consumers who may be trying to buy gas directly. There would be industry. In any case, there is a limit beyond which the free sale of gas is allowed. Don't have to go through the city gas distribution company also. So now we have these four large consumers, and then there could be small consumers who could also come and buy on the exchange. As far as supply of gas is concerned, we have traders who can sell on the exchange or who can sell otherwise also, and then we have producers selling directly, and then we have the large importers like GAIL and all also selling gas to the consumers through long term or maybe even short or medium term contracts. So all this, as the quantity of gas being deployed in the country grows, as consumers shift more and more to gas from other forms of energy, a very open and a very robust market becomes very important. So we have to learn from experiences from other countries, especially Europe and US, where gas market is very well developed and where they also have a very good infrastructure for transportation and distribution of gas. And we have to get regulations in place. Some regulations are already in place, but maybe some more would be required so that this gets facilitated. So my good wishes to all the panelists and all those who are participating in this, and we look forward to good deliberations. Thank you.
Thank you, sir. Thank you.
Thank you, sir, for those insightful words. But before I hand over the mic to Mr. Anish Dey, partner KPMG, who will moderate the panel discussion, please allow me to introduce today's panelist. We have Mr. Jean-Baptiste Dubreuil, who is a senior natural gas analyst at the International Energy Agency. He has in-depth knowledge of the energy markets with 2 decades of experience in oil and gas economics, market analysis, economic advisory and modeling, capital budgeting and valuation. Joining Mr. Baptiste on the panel is Dr. Egbert Laege, who is a leading expert of the European energy market. He has around 40 years of experience and is a member of the Supervisory Board European Power Exchange and is also the senior advisor in global commodity trading at Boston Consulting Group. Also on today's panel is Ms. Ilaria Conti, founder and head of the Florence School of Regulations, Gas at the European University Institute. Ms. Ilaria Conti has around 2 decades of experience in the sector, and she was with the European Federation of Energy Traders for around 10 years. Now I hand over the mic to Mr. Anish Dey, who is the Global Sector Head, Power and Utilities, KPMG, having more than 3 decades of experience. Over to you, Mr. Anish Dey.
Thank you, Sumedha, and thank you for inviting me to moderate this session. I'm with some very, very esteemed panelists, and I'm looking forward as much to hear their views as anybody else. So I'll go over to the first panelist, but before that, just a quick couple of context words. And I know that Rajesh and Mr. Kapoor have already laid the context in terms of how it happened in Europe and also what are the requirements and the realities in India. How far have we reached? What is the next step? Just to emphasize that a little more, and maybe that will provide even the speakers a little bit of a clue and context to this. I think Mr. Kapoor mentioned the energy transition through which we are going through, and that's just about started. But India's problems are quite complex because we are a growing economy. So our energy growth is going to be anywhere in the range of 3% per annum for the next 2-3 decades. That's the kind of growth which we are seeing, which is not there in anywhere else in the world, including in China, which is going to be much more muted. So we are trying to reform our markets, at the same time grow, and also at the same time transition the markets to cleaner forms of energy. Now, renewable energy is a big play in India, and Mr. Kapoor, in some of his earlier assignments, has been instrumental in changing the shape of the renewable energy sector in the country. But our journey is actually just about started, because even with 100 gigawatts of renewable energy, wind and solar and some other forms, and even if you include hydro, it's about 150 gigawatts. That is going to scale up to much more than 500 gigawatts in the next less than a decade from now. So that's the challenge. And because it is variable in nature, the renewable energy is often variable in nature, it has to be balanced. And this is where gas has a critical role to play. But then, our gas contracts, as Mr. Kapoor mentioned, have been oil-linked long-term often, and that has created certain amount of rigidities in the past. So we are looking at more flexible formats in which the markets can trade energy and couple various forms of energy together. And this is where both the markets point, which both of them mentioned, as well as the infrastructure to make it happen, and the regulations, all of them become important. And this is where the audience present would want to learn from Europe, because Europe operates in similar federated structure, has gone through its journey, is very high on renewables and getting even higher. And we have some additional challenges that we depend on a lot of external gas, just like in fact as Europe does, and today in the current geopolitics that makes it even more complicated. But given that cocktail of growth, energy transition, getting off coal, as well as creating meeting some of the national aspirations in terms of self-sufficiency, this becomes a very, very interesting context for this discussion. So may I now call upon our first panelist from IEA, Mr. Baptiste Dubreuil, to make his presentation. What I would request you to do is about 25 minutes, if possible, keep that presentation to about 25 minutes. We'll have questions and then, but if any of the attendees want to put the question in the chat box, I'll make a note of those questions, and towards the end, after all the panelists conclude, we will have the Q&A session. And I'm sure there'll be practical insights which we can take from the experiences from Europe as we design the gas markets in India. So without further ado, let me call upon Mr. Dubreuil to make his presentation.
Mr. Davies, dear colleagues, ladies and gentlemen, good afternoon. My name is Jean-Baptiste Dubreuil, and I am leading the IEA's natural gas analysis. This is a great pleasure to be with you today, and many thanks to Mr. Medurata and the IGX team for having me today to be part of this very interesting and very up-to-date discussion. So I've been entrusted with the difficult task of opening the round of presentation and providing an international view spanning 3 different regions and examples, highlights from experience in terms of natural gas markets opening in different contexts. So without further ado, I would like to start with providing you with one of the easiest takeaways from the market opening process, which is the evolution in natural gas prices over the past 15 years in different regions across the world. As you can see, I hope that you can see the presentation on your screens. This is information that is compiled by the International Gas Union and provides the level of competitiveness per market and per region across time. So you see that on the different bars, the share of regulated prices, so not set by the market, has been declining since the beginning of the century in all regions, with some dramatic changes happening in some regions, such as the Asia Pacific or the European region, to the benefit of market indexation, whether it be indirect indexation through oil and oil products, or direct gas-to-gas competition, which is the light green bars on the chart. One thing that immediately comes to the mind is that it's a long-term process. It doesn't happen overnight. Even if we're seeing now great progress being made in fast-growing Asian markets, whether it be in India or in China, just to mention 2 of them, the most leading ones, it is a long-term process that takes time and that needs a certain number of steps and components to be taken into consideration. So speaking of those, I'd like to, without rephrasing very excellent introductory remark made by Shri Kapoor, I would like to just say that to achieve a status of functioning gas market, you basically need to have 3 components, which are, first, your hardware is to have access to infrastructure, access to gas supply, and being able to deliver the gas to the customers. Then you need to have the software. The software is provided by the market facilities, be it an exchange, be it a different set of enablers, and providing facilities in terms of financial and operational services. And you need to have the user's manual, which is provided by the regulation and all the guidelines that set the framework for operating this market. We have put together on this packed slide a couple of steps and components towards this road to functioning gas markets. You can see on your left some of the building blocks. Some of them include, of course, very strong regulatory content, such as price deregulation, third-party access to infrastructure, unbundling of operational and commercial activities. Some involve market-related activities, having a sufficient number of participants, network capacity, involvement of ancillary services and financial institutions, and of course, the role of the government, which is pivotal to start the process and then hand it over to the market forces and the market participants to make it grow and become a functioning market. We want to describe it in an evolutive process, as you can see the steps on the right. So the first step is kicked by the government to move from a non-competitive market to a developing, progressively deregulated market. And then it's up to the regulators and the competition authorities to make it flourish and become both a liquid and functioning market. So looking now at the broad picture in terms of international feedback on gas market opening, see that across time we have had 3 different waves of market opening, starting with mature markets, but mature producing markets, which were basically self-sufficient with their own gas domestic production capacity, then moving in the late 1990s to mature markets, which were structural importing markets, whether it be in Europe or in Northeast Asia with Japan, and the third wave in the past decade with fast-growing importing markets. One important factor that I didn't mention in the steps and components in the previous slide, but which is an obvious fact that needs to be stated, especially in the current context. As you can see on the timeline, those deregulation processes were all kickstarted in periods where gas supply was abundant and affordable. In the early 1980s, in the United States and United Kingdom, in the context of the oil countershock of the mid-1980s, in the late 1990s, when the European process opened in 1998, Brent oil was below $10 per barrel as a result of the 1997 financial crisis. And in the past decade, we've had a decade of well-supplied and abundant supplied gas markets globally. Of course, the situation we're seeing today, and since mid-2021, is not completely favorable to that environment. But again, we're talking about a medium to long-term process. It's not going to happen overnight, and a great deal of steps have been already pursued in those fast-growing markets towards liberalization. So starting with the forebearer, the United States of America, the whole process started quite a while ago. Just to put back into the context, the United States is the oldest natural gas market, started in the early 20th century. And the first steps were, as in every energy market, a completely regulated market. From the 1938 Natural Gas Act and the 1950s system of regulated prices. The market opening really took place in the late 70s and unfolded in the 80s, again in the context of abundance. And because the United States was oversupplied with its domestic gas, which enabled this unfolding of the deregulation, starting with a relaxation in the gas pricing restriction in the early 70s, and then with the progressive opening of the network to third-party access in the 80s and the 90s, leading to the situation as we know it today. One important thing to keep in mind, if we look at the North American case, particularly comparing with the European case that my two colleagues will most certainly go more into the details in their presentation, is that the situation we're now seeing in the United States is a much more empirical and less, excuse me, less finalized than in Europe. First, the regulation in the United States is both a federal and a local state competency. So the federal agency, FERC, has issued a certain number of orders to make gas and electricity market deregulated for cross-state capacity. But at the state level, the status is quite different from one state to another. And this is something that you can see on the map on the left. The status of regulation, especially for retail customers, is really different from one state to another. You see that some states, both gas and electricity, are deregulated today. In some cases, such as Texas, it's only electricity which is deregulated. In some cases, it's only the gas markets, such as in Florida or in the Midwest. In some markets, both gas and electricity are still regulated. Second aspect, compared to most of the hubs and the trading places that we're seeing in Europe, or in the case of the IGX, which are virtual hubs, in the United States, we still have a series of physical hubs that really connect one with each other and create a complex network of pricing system and bases, local bases, the one with the other. Now, going to the European case, again, I will go very quickly because I know that my colleague panelists are both experts in that domain, and we'll go much more into the details of the European deregulation process. Just very quickly touching on two practical aspects of the regulation, which are the development of market integration on one hand and price discovery through a couple of empirical examples. So on this slide, you can see how the process is built at the European Union level with different levels of decision making and incentivizing investment and regulating investment. So with EU level project common interest, then 10-year plans which are coordinated at a regional level, and each transport system operator has its own national development plan for its own area of operations. Two very practical examples. If we look at some of the two of the largest European gas markets, Germany and France, the situation of market integration was not a given. Compared to the United Kingdom or Italy, which are also two large gas markets, which started with one balancing zone. In Germany and in France, it was certainly not the case. In Germany, we started the process with 19 different balancing zones, which progressively merged, as you can see on the maps, until last year to one single hub for the whole of Germany. In France, it's the same case. It took more than 15 years to merge the 7 balancing zones into one single balancing market in 2018. One of the onsets of the gas deregulation liberalization process in Europe is the development of trading places, of hubs, and more on them. This is the result of the European Federation of Energy Traders annual analysis of gas markets in Europe, which provides grades to the liquidity and business-friendly environment of those hubs. One striking thing is that the number of hubs grows almost every year. And now, as you can see, you have a quite important number of them. Of course, the oldest one that you can see on your left, the NBP in the United Kingdom, or TTF in the Netherlands are the most mature ones. They date back to the late 1990s, beginning of this century, but we have seen a lot of them emerging since then, and the level of liquidity is also increasing, as you can see with the bar charts. Another empirical example of the impact of the deregulation and market openings in terms of price discovery. And there I would like to share with you two practical examples from Germany and from France. In Germany, there's one widely publicized index, which is the average import price published by the German government, which is the dark blue line that you can see on this graph. If you look at its historical evolution, you see that average imports into Germany were almost 100% linked to oil indexation, which is the red curve that you have on the graph, whereas hub prices were clearly decorrelated from that. In the early part of the past decade, in between 2009 and 2012, we have seen a decorrelation of Germany's average import price to oil and a progressive correlation with market prices as the underlying long-term contracts were renegotiated to be based against the dominant market signal, which was provided by the hubs. A similar example can be provided in France. In France, there's still a regulated tariff which is published and reflects the supply cost of the incumbent company. And if you look at the evolution of the pricing formula that comes from the incumbent, you see that the share of market pricing, which is blue in the formula, against the share of oil indexation, which is red, has regularly evolved over the past decade to turn into 100% hub pricing in 2019. At the same time, it doesn't reflect a fundamental change in the structure of supply, physical supply of the incumbent. It's really how the market and the importance of market forces in terms of price setting have kicked away oil indexation and replaced it with gas-to-gas competition. One last step in that international tour is bringing us back to Asia. First, outside of India, just to give you a flavor of some other developments in Asia, based on an analysis that the International Energy Agency has done almost 10 years ago on the development of the potential for developing trading hubs in Asia. And at that time, the agency focused on 4 markets: Japan, Singapore, Korea, and China, highlighting a couple of blocks on the road that could hamper their regulation. Since then, we have seen that most of those blocks have been removed. And we're seeing that in more mature markets, such as Japan, the regulation is now complete. In the retail, for the retail customers, and legal unbundling of transportation is due to happen this year. In Korea, which is still a regulated market with a state-owned monopoly for retail customers, the number of direct importers doubled in a couple of years. In China, of course, there's a lot of reforms that have enabled to progressively move to city gate pricing from purely regulated pricing, and the incorporation of PipeChina, which is a state-owned monopoly that owns the infrastructure and not anymore the integrated oil and gas companies. Singapore is also going through the deregulation road, particularly for its use of electricity, which is almost 100% gas-fired. So with all those examples, and again, focusing on the very practical aspects of, again, the software, the infrastructure, and the hardware of the infrastructure, and the software, the pricing and price discovery, looking at the the Indian case, we're now in a situation, if we look at the evolution of the grid, there's a lot of projects going on, both on the transportation availability and also in the downstream with the rollout of distribution networks through the different rounds and hundreds of new kilometers being laid each and every year to develop city gas networks. On the other hand, looking at the benchmarks and the evolution of price discovery in India, although the IGX is still very new, it has been able over the past month to establish its own price discovery reference. If you look at the different benchmarks, that really reflects on the fundamentals of Indian market versus importing the fundamentals from other markets. So this concludes this very high level overview of international experience and feedbacks. Thank you very much for your attention.
Thank you very much, and that was really insightful to across the world. In fact, and it raises lots of interesting questions, especially your
Anish, we are not able to hear you. Some voice is breaking. Anish, probably you can put your video off and try to speak because there can be bandwidth issue.
Is it better? Sorry, my network suddenly seems to have played. Okay.
Yeah.
Now I was just mentioning. Yes, I was just mentioning that it raises lots of interesting questions. Mr. Dubreuil's presentation does, because initially you mentioned that it's markets have deregulated in times of abundance and stability, and that's not a condition which we at least are seeing in the near term here. So that'll be a question which I'm sure will be in the minds of the audience, and also the whole Asian markets, the buyers, where it's a buyer-driven markets, and how is deregulation going to play out rather than self-sufficient markets, I think, and that's a important question to maybe probe in the Q&A. May I suggest that we go to Dr. Laege as the next and for his presentation?
Thank you very much, Anish, and good afternoon to everybody. I'm very pleased to sit here on the panel and have the opportunity to share some experience from the European gas markets with you. But speaking about European gas markets and Europe, let me say first and start with a very personal statement. Because while we are speaking about these European markets and as we have heard about the great success story, we have to say that currently we have a war in Europe. And the war is caused by Russia breaking international law and the principles of the UN Charter. And I would like to say that I feel very deep sympathy with the people in Ukraine that are affected by this war, and in particular with my dear colleagues from the Ukrainian Energy Exchange, where I sit on the supervisory board. And in this part, I would like to strongly condemn the Russian invasion in Ukraine. I would like to state that war must never be a solution to problems, and certainly not in the 21st century in Europe. I think by that, I would like to thank you for allowing to say me this, which was very much to my heart. Now I would like to start my presentation. And Jean-Baptiste has been given the broad and global picture of the energy markets, in which the European energy markets are embedded. Maybe can you see my slides, or can we share?
No, it's not come up. I think it's not showing sharing. It's nothing on the screen. Can you again try?
I thought you would share.
Okay. Rohit, can you share that?
Yes, sir. Yes, sir.
Sorry for that.
Okay.
Yeah, so again, Jean-Baptiste basically painted the broader picture. And given my experience in the energy trading market, I would like to contribute from the market participants' perspective. And so what were the key drivers, and what was the intention of doing so? So I will provide this market participants perspective to the gas market, to the gas markets, and and when basically being asked by Rajesh if I could make this presentation, I was thinking back on my very early days in this European market. It was in '99, and I was trader number 3 in a company called E.ON, which is now Uniper, and which became one of the top 3 global trading companies in Europe. So it was, as you can see, within 10 years, 15 years, a very rapid development that took place. But if we go in hindsight, we of course can always say this has been a success story. But if we go back a little bit in time, and maybe the first slide, we should be humble enough to remember that, it was not so clear in the start that this really would be a success story. So we have, of course, starting with this very theoretical question, the macroeconomic question, why should we have energy markets or markets for energy at all, since this is such an important commodity? There were different views, of course, and there is this the overall governmental view, which is that energy markets based on competition will, of course, deliver a higher level of efficiency, which this efficiency will in the end lead to higher social welfare. And in the end, these liberalized and free energy markets will rapidly increase the rate of innovation, which is then helping the entire industry in the country, in the region, to increase global competitiveness, which I think is a very strong driver. The market participants probably have a more, isolated view. They, of course, are, experience or wish to experience that lower energy prices are delivered to them. And then, of course, having choice in the market will increase the overall level of service. But overall, we can say that it is the drive for efficiency that makes, that makes really the cause, that makes the reasoning and the argumentation. And I think we've heard this already, and we will for sure hear later on from Ilaria, that the key element, of course, is the regulatory framework, which is then enabling the growth and the development of these markets. If we move to the second slide, speaking about the market participants, although we just said that they were expecting significantly decreasing prices, the picture at the beginning was fairly mixed, whether players were welcoming this change and this transformation or not. On one hand, there were the incumbent energy players that had a very high level of concern from technical side, whether security of supply would be there, the level of service, would that be still guaranteed, there were as well high concerns how they would manage this transformation for their own business. And of course, because they were seeing let's say, an unclear, uncertain world, and they were asking themselves whether they would have the right capabilities and competencies to maneuver in this new market environment. And then, of course, there was with the incumbent companies a high level of concerns in terms of decreasing profitability of the business model. As I said, I was for more than 15 years, let's say, an employee of such a company, so this was really a struggle in the beginning as well to convince, let's say, to convince these incumbent players to start the transformation. And now I think in hindsight we can say that some of them are one of the most successful. Those who managed are one of the most successful energy players on a global field. At the same time, on the industrial and the SME, so the smaller consumers, there was as well, of course, let's say, a mixed picture whether they would welcome this change, because on one hand they were, of course, keen to have the lower prices, but and to have these individual procurement strategies that will increase their competitiveness. But at the same time, there were concerns about the level of change for their own business and whether they would cope with what was going on. In the next slide, so I like to show that over the course of time, and to some extent we have heard this from Jean-Baptiste, but we will for sure hear as well from Ilaria, that I think in looking back, there were some key enablers for these liberalized energy markets, and each of this enabler, and I have listed those I consider to be the 5 key ones, was in itself a very complex hurdle, but overcoming those hurdles, that really made the difference, let's say, in the market liberalization. And I think the most and foremost one is the unbundling of the integrated energy companies, which is splitting the roles between producer, importer, transmission operator, and then trading retail. Second, the creation of the independent transmission grid operators, so ensuring a reliable third and undiscriminated third-party access. And then releasing long-term legacy contracts to the market, which were initially held by just a very, very few number of players. So by that, ensuring sufficient liquidity and avoiding, let's say, monopolistic structures, we would never get a market and market liquidity go. And then, so while these 3 are probably the more obvious ones as well from a regulatory perspective, one key element was as well dissolving the destination clauses in the supply contracts, which originally in Europe was that, yes, I can deliver gas to you as a client, but you're not allowed, let's say, to take it away from your entry gate, where, let's say, basically your industry entry gate. So basically, only when this was destination clause was removed, then market participants could really optimize their portfolios and become active trading companies by themselves. And last but not least, an initiative that was not so much driven by regulation or government, but it was driven by the market itself, is the standardization of the trading contracts, which was really a necessary step to create the right environment. And that was facilitated by market participants themselves, predominantly via the association EFIT, the association where Ilaria did work for, and where I was, I think for 15 years, I was in the board, being, let's say, the responsible board member for the standardization of those, let's say, of those contracts. And if we move one slide further on, the unbundling was, let's say, was really a key point. I think Ilaria will focus in more depth on this, but maybe just 3 key messages on this from my side. So on one hand, this transmission system operator, let's say, has defined 2 different roles, and one was the transmission service, and the other one was the balancing role. And in particular on the balancing role and the balancing regime, which is performed at cost neutrality, that turned out to be really a key driver for market efficiency and liquidity. And when we now look back, and there was in the beginning a huge concern whether an unbundled regime could really ensure this balancing. So if you just have an operator who do not have gas contract itself, needs to source everything on the market, being dependent on other market participants to supply these structures, we have seen that this is really a success story in Europe. So the balancing actions really only take place in, let's say, in the very short-term period, usually in the majority in the last day before delivery, showing that all market participants behave in a way that they really seek to balance their portfolios by themselves. And therefore, the charges that in the end are being taken for being imbalanced are not so far away from the average gas prices during that day. And most significantly, because the sourcing of these products has been done on, let's say, on the exchange as platforms, this brought significant liquidity to these platforms and provided a significant element of transparency. So this was one key driver, which was for sure underestimated when being discussed in the beginning, but turned out to be really a substantial part of the liquidity provision. We move to the next slide. We can see that, of course, this unbundling made the energy market design significantly more complex. So if you have, let's say, vertically integrated companies, you basically have huge companies providing, let's say, all services, and then you have some companies who provide a fraction of their speed on the generation side or on the distribution side. And when you go into this unbundling, you get a lot of more different entities going around and needing to be coordinated, and therefore markets and prices are becoming the main signal for this coordination. And this is what happens during this unbundling in this unbundling period. And it is true to say that within this transformation part, sometimes there is some confusion, sometimes there is some inefficiency whether the prices are really providing the right signals to it. But in the end, we can say that let's say these periods of confusion, you just have to go through, and prices are efficiently able to manage and provide these signals, and in particular as well investment signals, for example, if infrastructure is needed. But the story, if we are really honest on this, is not at the end, because when we now look into what we will be expecting in Europe, we can say that let's say the development of technologies, in particular small-scale technologies, decentral production, producing entities, in particular on the renewable side, plus digitalization, will for sure lead that this, let's say, that this part will be continued, and that in the end of this decade, we for sure will have a much further deconstructed market design, where energy prices then are probably, will be the only way to coordinate and link all these different elements in. So I think digitalization and technology will anyways move in that direction, so that this is without choice starting this journey, and are, going the way until the end. If we go to the next slide, this shows what in the end it delivered. We've heard already something about the hub structure from Jean-Baptiste, but so we see here on this map of Europe, we see the national markets as Jean-Baptiste described. It was a struggle in itself to basically combine and integrate the national markets into one balancing zone, into one hub, and in this picture, even the latest integration of Germany into one hub, into one balancing zone, is not yet shown. But we this was in the end managed, and but it is true that this was clearly facilitated by a well established infrastructure, so that really facilitated the speed of this interconnection, and as well the harmonized grid codes within the European regulation, which was for sure, a more difficult case within, multinational Europe in comparison to what we can expect in India. And then the Dutch TTF is the one that is taking the lead hub for the entire continental European part. And this in itself actually is a surprising element, because if you look at TTF, this is in, small Netherlands, for clearly not the largest consumer, for sure not the largest producer, but it has been the hub that was the smartest, I would say, that was the fastest, that had the most appropriate regulation in place, and offered, the most adequate element for a trading environment. And I think this says something as well, that not necessarily demand and production are the key elements to decide which area is becoming the lead. It's more on being fast and speedy for that. And if we move to the next, maybe one word to UK, it was in the beginning, that as Jean-Baptiste said, it was in the beginning the only hub, but due to the, lower connectivity to other markets, and of course a declining production, NBP lost its role as a lead indicator in Europe. And basically this is now on TTF. We go on the next page. We can see here, the correlation between the different hubs as an element of a price index. So we can see that this is an almost perfect correlation, which only of the price developments. The absolute price differences only represent the transportation costs, basically away from, from the TTF hub. And we only see this, a little bit, distorting towards the end of last year, when energy prices got higher. And then in the end, the ample infrastructure did not really help, because there was a lack of gas, and gas flows started to change a bit. So, but still in those times, you see a very, very high level of correlation of the prices, which is a clear sign of the efficiency of that hub structure that we have in Europe by now. If we go into the next part, into the next slide, this efficiency was actually started with the day ahead markets, with the physical markets. That was really let's say the starting point for, let's say, for those markets, where players started to balance out supply and demand. And in daily spot auctions, as it was in power, or because gas started a bit later than power, it was already continuous trading. And then together with the balancing markets that were on the platforms, the intraday dispatching and intraday markets became more and more important. And once those have been forming a solid, reliable price index, then financial markets developed on them, which are in power took maybe 3 to 5 years. In gas, as said, because it was a bit coming a bit later, that basically went fairly quickly. So within a time span of 2 to 3 years, then financial markets were developed as well, because they serve in the end for let's say the procurement and risk management. And this was let's say this was a process we've seen first to happen with power, and then let's say with gas as well. And now we have the situation where about 20% of the total consumption is traded on, let's say, on the spot markets, on the physical spot markets. And the churn rates on the financial markets are, it's always a little bit difficult, let's say, to calculate this, but are roughly in the area of 10, probably even above. And so indicating that these are really some very sufficient and efficient trading markets. If we move to the next slide, we can see that in particular the exchanges played a central role in this let's say development of the trading market. Maybe let's say in the light of time, I'm not going through, let's say, through all of these roles, but the exchanges clearly cover the entire scope of let's say of the products. They all have it on one platform, and let's say they have this price anonymity, price neutrality, and offer the clearing services in terms of credit risk management. So that really brought them into let's say into a key role to develop these let's say to develop these markets. And maybe if we, let's say, if we move to our, let's say, the next slide, we can see this is just a, let's say, just a tiny little snapshot about, let's say, coming back a bit to the social welfare that is, let's say, provided by the market, and clearly as well by the role that the exchanges have, is that while we had the price peaks and still have the price peaks in Europe by end of year, we can see that, let's say, those, because there was a reliable, transparent price index that basically could be disseminated, that this was then able to deviate, or let's say change global production patterns, because usually Europe is a price taker of global gas. So actually LNG usually is delivered into Asia because Asian prices are higher. But with the, let's say, with the price indices in Europe signalizing a shortage, as well, global commodity streams could be deviated into Europe. And I think this is as well showing how important this is, to have these transparent and visible price indicators in order to have an efficient supply of the economy. If we move to the next, let's say, to the next slide, we see some let's say some of the let's say of the growth of the trading volumes that let's say that we have in Europe. And maybe if we just look at the Euro gas, so the second block, we see this very steep development of the trading volumes, and this is really are expected to further increase, and it is fair to say, if you combine that to Europower, which is almost stable, I would say, this is one of the reasons that while in the power part we had let's say the significant growth in the 2000s, the trading market in gas really only picked up around 2010. So early starts in trading was about 2005, but then it was in 2010 when markets really started to deliver stronger growth parts, and in particular the last part of the decade. And what you can see here as well is the gray bar, which is the exchange executed element. This is growing significantly over time, and a peculiarity here is as well that you have a broker bilateral market which is cleared, where you can use let's say clearing services on the exchange as well, so that we now have let's say in Europe, let's say on the continent, about 50 to 60%. I have to say these numbers are borrowed from a broker association, so they are I would say to a limited extent accurate, but I think they give a good impression. I think we are a bit more than 60%, almost 70% is exchange traded. So that shows let's say the key role that exchanges are taking in that place, and in particular in times with high price volatilities, meaning high credit risk issues, the role of exchanges with their clearing and securing functionality will become even more important. And that brings me to my last slide. If we go back to the question I asked before, so in hindsight, was it a good idea? Is that really worth, let's say, trying it? I think now we can say that everybody, every player, every stakeholder in this market is in full support of this liberalized market structures. They have been in the last, although as we could see in Jean-Baptiste's slide, although they have been declared already 30 years ago, they only started to really be implemented in the market since 20 years in power, and maybe only really since 15 years in gas, but they are now really firmly established. They have shown that they can deliver efficient markets and ensure the security of supply. And they have as well shown, as I said before, that exchanges really play a pivotal role to orchestrate the prices and the markets. And they have as well delivered a complete new business stream in commodity trading and risk management, which was not existing in this market before. And when we look ahead, these market structures seem to be suited as well to, let's say, to face the challenges of the next decade, which is, of course, on one hand, integrating the non-domestic production, so LNG, into these network structures, but as well enable this sector coupling with the electricity sector, which I think is one of the elements Ilaria will focus on, and is one of the issues that was raised by Anish, by yourself as well, is the integration of the renewable, let's say the renewable energies, so that the sector coupling between the power and electricity, between the power and the gas sector, is something that is working very efficiently through these markets. And then last but not least, they are getting ready as well to integrate the hydrogen within the, let's say, within the liberalized market structures. So by that, I would like to, let's say, end my presentation. In hindsight, it is a success story. It was a no-brainer, but there were many hurdles and many complex elements to overcome. But I can only encourage to develop those solutions and develop, I would say, bespoke solutions for that. It's a process of learning and adapting and changing, and that in the end made the success in Europe. Thank you very much.
Thank you, Dr. Laege. It's fascinating. 1.5 decades is not a long period. And in that, we have seen the whole scenario turn around so much, from a completely rigid structure to a market-based structure where the market is clearly dominating. I think you made lots of points, including, and the one which caught my attention was the growth of the TTF, that it's not the largest market, but the most nimble player, which makes a difference, because this is all about innovation, flexibility, rapidly responding to it, and also creating the confidence that the kind of bespoke development which has to happen can be supported. I'm curious to understand later, and you started with the geopolitics and your view of that, but then in the force of sustained disruptions from geopolitical conditions, how would markets serve in those conditions? Is I think it's a question. I think it's a little open in my mind, but that's maybe we can take it up in the Q&A. Not so much the specifics of it, but the concept of it, that what happens in the situation of sustained geopolitical disruptions. So that's a fascinating field. Thank you so much again for that. And we'll now go over to Ilaria Conti, Head of Gas at Florida School of Regulation. In fact, as it happens, my former colleague, Alberto Portocini, used to be there, and a very dear colleague of mine from another time. And so look forward to your presentation. Are others able to hear?
Sorry, Ilaria, you are.
I think, is it working?
Yeah.
Perfect. Okay. I had some little issues with the screen sharing. Okay, so hello, good afternoon, and thank you very much to IGX, to Mr. Mediratta for the invitation to this very, very interesting debate. After the excellent presentations by Jean-Baptiste and by Egbert, who brought many interesting insights, I think, on the evolution of mature gas markets by bringing the overall vision and also the markets element. It's now my turn to complete the perspective, to complete the overview by bringing the regulatory and policy perspective on this evolution. So let's start by trying to understand what the vision for the evolution of gas markets has always been. As we learned, European energy regulation starts in the late 90s. So we have approximately now 25 years of experience in regulating energy markets and networks. But back then, we couldn't really speak of a single energy market, because Europe was rather a collection of national markets, national energy markets, with the presence in each member state of very often a national champion, a monopolist for electricity and gas. So it was rather a collage of markets rather than one single market. So the vision for Europe was immediately the vision of achieving what we can see here in the right side. So a map where you could hardly see the borders, but you could very well see interconnection points, points of generation of energy, and that could run in a smooth way with the energy flows running smoothly across borders. Of course, in the end of the 90s, we were very, very far from this vision, because as we can see instead on the left side, that was the market structure, the typical market structure. So between upstream and downstream, we would have producers and importers. So energy would be either produced or locally or imported. The link with the consumption side, with the downstream side, so with industry, residential, any type of industries, and also power generation would be following state-controlled and end-user prices. So no liberalization, no liberalized market. So how did we get there? It was, let's say, the urgency was really to move from the old world based on price discrimination and on the strong presence of long-term take-or-pay contracts to a situation where we would have mature markets with a transparent gas index measures value. So the idea was to move from oil indexation, which was the basis of long-term contracts, till a different system with a transparent gas index, so that gas price would be finally transparent and could become an important reference. Of course, the transition took a while. It was neither quick nor easy nor smooth. And there were, at many points in time, the tensions with the existing long-term contracts. Companies struggled, as we heard from Egbert right just a minute ago. It was not immediate to make sure that this transition could be fully understood by the incumbents, by the old players, the pre-existing players, and also implied a change in the structure for many companies. And of course, all of this transition was supported by an evolving regulation. So regulation was not set in stone as of day one. Regulators themselves also had to learn how to move in this new environment and to adjust targets to the evolving gas markets. So together with the markets, regulation had to evolve. But what the target was has been immediately clear. The target, the precisely chosen target in Europe was to obtain a liberalized market, an open market, where one of the first elements, one of the first building bricks would have had to be competition. So the vision was clear. We would get to a system where companies would have had to have a new role, independent, and they could be enabled to sell gas in the market without having networks. So this was the very first clear difference with the past. Originally, a generating company would also have the property of the networks to supply the generated capacity. In the new system, more competitors, more players would have had the chance to act and to participate without having the networks. So more competition and more opening towards new players. So let's see how this liberalization started seeing the light via regulatory interventions. There were, first of all, some European directives and regulation, and this process actually starts in the late 90s but goes on until the late 20s. These directives aimed at, first of all, abolishing these national monopolies that I meant, by introducing a series of principles which are still nowadays the key pillars of our current energy markets regulation. Unbundling, we will see later in more details, third-party access to infrastructures, the abolition of destination clauses, which was included in the long-term contracts. So via these long-term contracts, the the gas flowing into Europe would have a predefined path included in the contract, so established by contract. With the opening of the energy market and the liberalization, this is not the case anymore. Also, the regulatory initiatives aimed at opening the downstream market, and they were responsible for setting and establishing more clearly the independence of energy regulators. After, let's say, the late 20s, so the late 2000s, so let's say starting in 2010 approximately, the focus of regulatory intervention shifts more towards the promotion of hubs. So from the 90s to the late 2000s, the focus was really trying to demolish somehow the status quo of the energy markets. After 2010, the main aim is really strengthening what had started emerging in terms of new market structure, new market dynamics, and so the regulators started facilitating these initiatives, which were sometimes market-based initiatives, initiatives coming directly from the market. And Egbert brilliantly mentioned as an example also the need for standardization of contracts, which was really a market initiative, 100%. But the regulation's role in this period is really facilitating and strengthening such dynamics. And of course, with the emergence of hubs as marketplaces for the exchange of gas, where physical and financial trading would take place, we see, and we will see in the next slides, that how regulation acts to support these initiatives. And also in this period, we contemplate the emergence of really what can at that point be called the nascent European energy market. So looking a little bit more into the details, of course, there were several regulatory initiatives starting in the 90s. We had a first and a second energy package. And by energy package, we mean a set of regulatory measures, directives and regulations typically. I will skip that. I will skip the first and second package and would focus on the third, which is certainly out of the three the most important one, because the third energy package, which entered into force in 2009, really contains the key principles that are still funding pillars of today's energy market. What are these principles? These principles are certainly competition, ensuring a level playing field among market participants, a principle of non-discrimination, again, against market participants, ensuring that every market participant has equal rights to access infrastructure and participate in the market. And the establishment of market mechanisms, typically for the allocation of capacity. Without maybe focusing too much on each of them, you have here a brief description of the main benefits that each of these principles actually brought to the nascent energy market. And by the way, these principles are equally applied also to the electricity market. So because the third energy package is not only about gas, it addresses both electricity and gas markets. But certainly third-party access to pipelines is a very important principle, which is clearly introduced with this package, and unbundling, which means unbundling of transportation from supply, so the separation of generation from supply activities in the market. Also, with the third energy package, regulated tariffs are introduced, tariffs that ensure that all market participants pay the same tariff. This was not the case before. So typically, when it comes to transportation tariffs in gas, the third energy package is very specific. There is even a network code for tariffs, which establishes how these tariffs should be calculated, should be set. The third energy package is also, as I said, also puts a strong accent on independence of national regulatory authorities. What happened before the third energy package was often that, yes, NRAs would exist in some member states, in the majority actually already by 2009, but these national regulatory authorities would not be really independent. Typically, they were sometimes a department of the national government. They were maybe part of the Ministry for Energy or for Economic Development. So the third energy package clearly establishes the independence, the rules by which these NRAs should be set, and also foresees that they should have a separate budget, which becomes, as we know, a very important element to ensure independence of a certain entity. The third energy package is also the one which sets the current system we have in place in terms of gas market model and the entry-exit system. Without it, it would have been very difficult to think of the picture we have today with many hubs, just as we saw in previous presentations, which work very effectively and are liquidity enablers. The third energy package also changes the institutional framework by setting up 3 European, let's say, entities in the energy sector. ACER, which is the Agency for the Cooperation of Energy Regulators, which is part of the Commission but independent from it, and basically gathers at European level all national regulatory authorities. And then ENSOG and ENSOE, the European Network for Transmission System Operators for gas and electricity, respectively, gathering national TSOs for electricity and gas at European level and facilitating their cooperation. With the third energy package, we also see an important novelty, which is the obligation on TSOs to develop the 10-year network development plan, which was mentioned earlier on by Jean-Baptiste. And these network development plans must take into account connection to other networks. So it's with this, the era of TSOs looking into their own restricted field ends, and these TSOs are somehow obliged to think at a European level and connect to neighboring systems. And as I said, last but not least, the third energy package includes the so-called network codes that are specific rules, very detailed rules on electricity and gas markets functioning. And each network code really addresses one element, one important part of the functioning of electricity and gas markets. I did not include here the electricity ones. These are just the gas network codes, just for information. And in brackets, you have the year of entry into force. What are they about? We have the capacity allocation mechanisms network code, which is the network code responsible for changing the way gas capacity is allocated. So with the entry into force of the CAM network code, the era of a first come, first served mechanism sees an end, and market-based mechanisms are used, such as auctions, for the allocation of gas capacity. Then we have the congestion management practices guidelines, a specific set of rules aimed at avoiding contractual congestion, so not physical congestion, but contractual congestion, and reutilize the unused capacity at interconnection points, and typically helps avoiding this called capacity hoarding, which was also a common practice before the third energy package. Then we have the balancing network code, really disciplining and somehow revolutioning the functioning of the balancing network code by putting more responsibility in the hands of the shippers. As we heard from Egbert, that this was also a big change and there were many fears that this new system wouldn't work. But in fact, it works very well, and it is also thanks to the balancing network code, which gives different responsibility to the shippers to be imbalanced and relieves somehow the responsibility from the TSOs, which becomes just a monitoring, who just is left with monitoring responsibilities. Then the tariff network code, very important one, as I said, establishing how transportation tariffs must be set up and also providing some guidance, some models of reference, and also highlighting that transparency in setting up these tariffs is very important. And last but not least, the interoperability network code aims at removing the technical operation communication barriers in gas flows. This is quite, let's say, uncontroversial network code because it really helps the harmonization of gas flows across borders in Europe, typically by harmonizing measurements units and similar elements. Now, I thought it could be interesting to focus some slides on the concept of unbundling. When the third energy package was published, despite including all the revolutionary elements that I just mentioned, I remember that the big scandal of the third energy publication related to the concept of unbundling. Indeed, this was certainly a very strong step, a very strong stance that the European Commission decided to take by following, as we said, the main target of dismantling the existing monopolies. So in order to be effective in this action of opening the market, liberalizing the market, and allowing access to several competitors, unbundling was considered a very important and necessary, absolutely fundamental step. So three forms of possible unbundling were allowed by the third energy package. One so-called ownership unbundling, so the clear-cut, complete separation of, in the same company, of course, of the generation activity from the transportation activity. And now the second model was instead the so-called ISO, Independent System Operator, where basically the assets, the generation assets, would remain the property of the integrated company, but a separate body would be responsible for the maintenance of the networks. And a third model, which was actually initially not included in the third energy package, but then was accepted based on the legacy of which was existing back then, the so-called Independent Transmission Operator, ITO, a system of detailed rules ensuring autonomy, independence, and investments necessary in the transmission activity. Since it's not always very easy to understand at first sight what these three models imply, perhaps graphics can help. And as you can see, this is the ownership unbundling model. So we would have the vertically integrating undertaking, so the mother company, completely separated between generation, production, and supply from another company. So we are talking about two different companies, one responsible for generation, production, supply, the other one for operation, maintenance, and development of the transmission system, but also for its ownership. That's the important difference. When it comes to the second model, Independent System Operator, we would have the mother company, the regional mother company, keeping generation and production, having a transmission system, or being the owner of the assets, as we said, and separately another company which would only be in charge of operation, maintenance, and development planning of the transmission system. So ownership remains here, but operations are managed separately. And the third model, as you can see, the difference with the original vertically integrated undertaking is not big because basically the company remains the same. All the properties remain within the regional mother company, including transmission, but as you can see, I'm sorry. Here there is a thicker layer is established within the company to make sure that the activities are somehow kept separate. And this layer thick usually includes a very complicated, a complex set of rules, making sure that, for example, the same persons do not work for both activities, are not linked do not deal with, let's say, different activities, different segments within the same company. Now, if I have some more time, I will quickly go through the other, let's say, regulatory provisions that are not binding in this case. So the third energy package provisions were absolutely binding. They are primary regulation, but we have also some other, let's say, indications, some other visions that were somehow implemented in regulation and policy. In 2011, the Council of European Energy Regulators, CER, published a so-called gas target model, which was based on 3 pillars: enabling secure supply partners, establishing functioning wholesale markets, and establishing a tighter, I would say, connection of markets. The gas target model provides a vision which complements the regulatory provisions that we have just discussed. So far from being a binding regulation, it's just a model, just a vision, which explains, which puts forward the direction for the evolution of the European gas market. The rationale was that competitive markets were finally starting to emerge at the beginning of the 2010s, but the risk was that these markets would still, albeit being competitive, would still remain some sort of islands, which would have, let's say, jeopardized the overall vision of a single energy market for Europe. So CER felt the need to publish these guidelines, this indication, as to explain better what the final target should be. In 2014, ACER, the Agency for the Cooperation of Energy Regulators, updated this gas target model and insisted on another important element of the evolving gas market, which was fostering liquidity at gas hubs. So this new target model really encourages hub liquidity and regional market integration. And also the fact that electricity and gas markets should start talking to each other, particularly when it comes to the functioning of gas-fired power plants. And this, we can say, is actually a very pioneeristic element, because as Egbert mentioned, the recent discussions in the further evolution of the energy markets really include an important element, which is energy system integration, or sector coupling. So the closer and closer integration of electricity and gas markets, possibly with other sectors too. So that's we are at 2014. Just to give you some additional elements, the gas target model second version is very much detailed. It explains clearly how these hubs should be identified, and what is actually a trading zone, which should also be a balancing zone at the same time. And for smaller regions, for smaller zones where we can't speak of a trading region, there are alternatives. They can merge with other national markets, they can build a common trading region, or become a satellite of a liquid market. So very clear and detailed rules to encourage the development of hubs and the progressive integration. All of this was possible thanks to the overall overarching market model called entry-exit. So in moving from national markets to a single energy market, Europe can be imagined finally as a one single zone with the entry points for injection of gas and exit zones that are internal. So again, this represents a move forward from long-term contracts with a predefined path for gas to a system where basically gas can enter anywhere in Europe and exit anywhere. And of course, the fee is related to the different interconnection points. So we get finally to the mature European gas markets we have today, thanks to the presence of hubs we already discussed in previous presentations. And you have also seen this important exercise that IFED performs almost every year, the gas hub benchmarking study, which clearly illustrates an evolution. Here you see only some, probably the most recent hubs in Europe, letting aside the most advanced ones, the mature ones like TTF and BP. You see that there is a consistent and significant growth in also the newest ones. So we can say that European gas policy was successful in particularly increased price convergence. It enhanced competition and overall lowered system costs and increased security of supply. This also in case of crisis, because as we already noticed, there is a strong price convergence between the different gas hubs in Europe. But this has not always been the case. Actually, only a few years ago, maybe 6-7 years ago, the difference was still quite consistent across hubs. And what's actually one of the things among many that the recent crisis has shown is that this is a graph from January to September last year, when we can see here around this period the gas prices, energy prices started rocketing. You can see that it's almost one line only, so that's showing that price conversion, even in case of crisis, was very, very strong. And with this, I would like to conclude, and I thank you very much for your attention.
Thank you so much, and thank you, Thomas, for taking us through that journey on regulation, the various packages, and how it evolved, the formation of the institutions, which was so critical for doing this, the unbundling and the formation of institutions, those institutions being strengthened through the codes and the rules. And I think that's again over a relatively short period of time for all of this to come together is indeed quite fascinating. So the sum and substance which one can derive from all of these presentations is that the questions or doubts which may have been there earlier, 2 decades ago on this, now stand reasonably well rested, well settled, and there is broad acceptance and performance in the markets also to kind of show for that. I'm going to open it up for questions. I think some of them have started queuing up. There is one which is not directed to any particular panelist, but or presenter, but says that how extensive is the gas storage practices in the US and EU? And are there regulatory guidelines for gas storage of operators? What aspects of regulations are there? I'm just wondering whether any of you would want to take that up.
I can give a start. I'm not sure whether I have completely understood the question entirely, but so there are independent gas storage marketers in Europe. They are unbundled as well. There is regulation around them, of course, but what we have seen. But maybe as we see in the current discussion with the increase in prices, maybe not to a sufficient extent from a, let's say, society perspective on, that, for example, there are minimum requirements on how much of your reservoir should be filled by what time. This is now currently been discussed, but there is regulation around it. The storage operators are commercial players in the market under regulation, but requirements, let's say, may not be sufficient as we see now in these extreme parts, and taking this as a, or let's say as what I mentioned earlier, I would consider this as this learning experience that we have, that you start probably with some kind of lighter part of regulation, and then you add on certain things which you realize during the course of time that are necessary to give, let's say, to draw the right outcome for the society. Maybe not for all the time for the companies involved in that, but I think that's exactly the role of regulation, to make sure that let's say the society is given its right.
Yeah,
Right.
maybe just to complement what Egbert very correctly said. Yes, indeed, there are guidelines at regulatory at European level, but then it's up to each member state to decide which additional regulation to put in place for storage system operators. And what Egbert mentioned is indeed a very important point, which is currently discussed. We noticed that when the recent energy crisis started and prices started to raise, there was a significant difference in the level of storages located in those member states where storage was more heavily regulated, rather than left more to the commercial activity only. And eventually, also because of the let's say unpredictable behavior of some companies, particularly one when the energy crisis started, the level of storage, of commercial storage in some sites in Europe was particularly low. This didn't happen in countries like, for example, Italy or Hungary or France, which have stronger rules regarding storage. So they have a strong regulation in place. So, for example, obligation to refill storage is at the end of the summer or during the summer, so that when the cold season starts, they are full. These are rules that are in place only in some member states at the moment, but the Commission is evaluating applying them to the whole of Europe.
But a follow-on question, in fact, if I can put from my end, how is that storage paid for? If it's a mandated storage, then who pays for it?
In Italy, well, it's an obligation on the companies, eventually, probably companies have their own way of recovering for these costs, obviously. It was a long debate, but in Italy, for example, you also have some so-called strategic storage, which actually belongs to the government, and the government can decide to activate in case of severe energy crisis. And in that case, that strategic storage is reserved and is used. And of course, because it's really the last resource, the last supply resource, it is used only when typically gas price is very high, and then it's put on the market. So it is pretty, let's say, complex mechanism, very hardly criticized in the past, particularly by the private sector. But we have the proof that somehow it worked, and it worked. It proved quite successful in particularly severe times.
Yes, and it's not just about prices, but also sometimes about supply security, which has to be overcome because of that. We have another question which says that what is the minimum consumption or trading volumes for individual customers, who can participate in the market? because there is in the Indian stipulations of 50,000 standard cubic meters a day, as per the person who's put that question across, is far too high. So is there a European standard of some kind, or is it different countries have different standards? How does it work?
So maybe I can take that question. So there is no minimum requirement. So anybody can participate in this market. You need to have to fulfill certain requirements in terms, for example, when you're in the physical market, you need to have, let's say, fulfill the shipper requirements. And then let's say the minimum size you can trade is basically the size of the product. So there is no link between your domestic production, your consumption or production in participating in this market.
Right. So I think the couple of other storage conditions questions which I think we have broadly addressed. But this one is important. The last one is important, that it is driven by the product in the market, and the more divisible the product in the market, the more the participation becomes. So maybe there is a reason for India also to relook at the regulations which predate the existence of the competitive markets, and some of those updates, not just here but on other matters, will have to be carried over. I'm just looking at the question queue and seeing whether there's a distinct question. There is a question on the gas sourcing, and the question goes: won't it be difficult to source gas within the prices, with prices to stay at the elevated levels this year? And further, whether mandatory storage levels will cause future tightening. Maybe we can go to Baptiste for answering that question.
The price environment has been particularly challenging since the end of the past summer in Europe, and by repercussion on the short-term markets in Asia, which depend on LNG as a spare resource. This has led to some measures, emergency measures being taken by governments in Europe to protect some customers, such as a freeze in prices, or helping some particularly exposed customers. But I think that talking about the challenging environment is both in terms of price levels and very high level of volatility also for wholesale customers in terms to hedge their energy costs. The situation we're seeing now in Europe is, of course, very challenging and very uncertain in terms of physical flows. The European supply has been ensured in spite of a strong drop in Russian pipeline volume to Europe, thanks to strong contribution of LNG and other pipeline suppliers. Also due to the fact that the heating season has not been as strong as expected, thanks to mild temperatures. But this additional supply coming from the LNG market is basically fishing in the same pool. So all the cargoes that are going to Europe have been withdrawn from other markets, and particularly from the Asian market, where the price situation is also quite difficult to bear for much customers.
Right. It is indeed I think this will all play out, and it will also depend on how the war stretches and what are the consequences of that. But it does look very unpredictable at this time. At least from us, from India, we are trying to still make sense of where this is all headed. But I'll go to the next question.
Maybe can I just jump in and to answer the question that you raised after my let's say my presentation on the prices? This fits now nicely in due to the geopolitical situation. I think when we look scientifically at this, what the market is delivering as price signals, I am pretty sure that we will have a wonderful case study in this, let's say, over the next, let's say, when things have been settling down, because we can see as of summer last year, prices slightly increasing because of Asian demand picking up, as Jean-Baptiste said, but as well the discussion in Europe about carbon reduction. So basically coal already been anticipated to be too expensive. So carbon prices were rising. So we saw a slight increase. Then we got a we got a forecast of cold weather sometime in September. Will be very cold winter. So then usually, let's say, gas prices picked up, and for the first time, people realized, oops, gas storage is not full. And that basically then started, let's say, to increase. And then with all the messages that were coming from the geopolitical crisis, there were reactions on the price market where you, of course, could say at that particular moment, this is exaggerated because fundamentals there were still supplies. But you could as well say that maybe some markets did already anticipate, let's say, the situation of price levels when there are no flows anymore. And so, although there is a shock to the system, as well in physical terms, in case demands are cut off, markets and price signals are working efficiently. And I think that's, a strong message as well in this time, so that, let's say, that at least until now, there is no collapse of the market design and the functionality and the price signals in this situation. It's rather the contrary. I think it helps significantly to provide transparency.
Well, that's perfect, and I think roughly that clearly has been the case which is demonstrated. But I do worry sometimes when it comes to the retail end of the spectrum, and you have tightening of the hardening of prices, causing some troubles with the customers, and governments trying to intervene in that process, and then the equation goes out of balance. So you might have a wholesale market which works perfectly, but the retailing part of it gets disturbed because of governmental intervention, and hence that coupling doesn't work any further, which then flows back into the wholesale markets in some form or fashion. And I say that because that's always a fear with which we have lived in India, that the governments will intervene in retail prices the moment it goes a little out of hand.
Is a temptation that we can read in European newspapers as well. Of course, it makes you popular as a politician if you say, let's cap it. There might be as well smarter ways of compensation for that, let's say, so that indirectly you leave the prices and pricing mechanisms, but you give support to the people affected and who for social reasons cannot, let's say, part in that. But yeah, it's a discussion we have, and if the crisis lingers on and prices keep on that level, for sure will become very apparent in Europe as well.
Right. A follow-on question maybe to Jean-Baptiste are these high prices signaling to new investments? And not just the high prices, but the geopolitics. How do you see it signaling to new investments? Because the oil and gas sector in particular, and oil and gas investments sometimes cannot be differentiated, right? Upstream investments are what they are. And that has been low. Since 2014, we have been only investing a fraction of what we should be doing. At least I think the IEA has brought out the underinvestment story in the past as well. So how do you see that playing out, say, in the near-term future, next 3, 4, 5 years?
Well, thanks, Anish. I think that looking at the investment side is also a very complex dynamics. We have, if we look at the past decade, we've had record level of investment, especially on LNG, liquefaction capacity, just before the unfolding of the COVID pandemic in 18 and 19. 19, we had up to 90 BCM of new capacity sanctioned. Of course, since then, the trend has changed quite significantly. The situation we're seeing today is, of course, favorable, more favorable in terms of fundamental from a supplier's perspective. But securing a final investment decision is not something that you can do over just a couple of weeks, couple of months of very high prices. You need to have, especially in those energy prices where the bulk of the volume needs to be secured by long-term agreements. Those are not fully merchant projects. So means that the dynamics will be much more complex to harness, especially given in dual context of both a strong drive into decarbonization, which means that gas remains a strong bridge, but for how long, especially for the more mature markets in Europe and across the Northern Hemisphere. And second, there's still a very strong, I would say, prudent financial guidance from energy companies still recovering from the very low price environment of 2020 and still not reluctant to commit into long-term investment in the current situation. So the short answer would be yes and no, and we certainly need to wait a bit more to see if the current situation translates into more final investment decision.
Great. So yeah, I have another question on the queue, which basically asks how tightly is the energy market and the environmental market coupled in Europe? And how, I mean, if I had to add a little color to it, how do you see it evolving? Because environmental markets and, haven't been that consistent. The way energy markets have behaved, people could say that. And maybe Dr. Laege, you would want to take that on?
Yeah, so they are interlinked very, very tightly since the carbon prices, let's say the emission, let's say carbon emission prices provide the link between, in the end, the dark spread and the spark spread, as you would say. So basically the difference between producing power by coal or producing power by gas. So that is basically the linking part, so that you can see very nice correlations, and I would say almost perfect correlations between coal prices, gas prices, and carbon prices. So the EU emission is, let's say, is the link for, let's say, the environmental part. Very recently, you see more as well, kind of this origin guarantees of origin, which is slightly different in pricing. But as they become more and more liquid and become more traded, you see as well price correlations on that. So in the European scheme, you see that, let's say, once you have introduced that, it's very well anchored, and it's all kind of, let's say, traded in sync.
So the same trends as the hub price coupling that you showed us, that the hub prices are very, very closely related.
Yeah.
Exactly.
By the transmission prices here also, of course, different products, but it's very similarly linked. That's what you're saying.
Because you can always translate this into, let's say back, basically coal plus certificate, gas plus certificate gives the power price, and in that it's a very simplistic linear equation.
Right. Okay. We will conclude. I have a common question for each of the panelists in the end, and then I'll hand it over to IGX, the moderator at IGX, to take it over. But before that, a question on the TSOs, and maybe we will go to Ilaria for that question. In India, there is a proposal to set up a joint venture TSO, 50% from the government and 50% from industries. That's how the question goes. Whereas in Europe, it has been fully government-owned. The TSOs have been government-owned. How does it play? What's your opinion of them when you compare the two models?
There is not really homogeneity or harmonization in this also in Europe. There are different TSOs are participated by different shareholders and different types of shareholders as well. But of course, in Europe, we opted very clearly for TSOs and DSOs to be regulated monopolies. So of course, this is an important feature of our own system, of the way Europe decided to structure the market. So in fact, I think I'm not sure what the main advantages can be. For me, it's more what sort of regulation applies to any entity. And then, of course, I suppose that if there is a participation from private companies, then there are different interests. There could be different interests, and maybe there could be even potentially conflicts of interest. This said, I have no evidences to say that a fully public TSO would work better or worse than a fully private one. So it is quite a difficult question, because in Europe the main choice regarded the way these TSOs would be regulated, not so much on the participation of shareholders into TSOs.
Right. So it's a matter of regulation and governance, principles rather than the ownership itself. Great. So one last question to each of my panelists over here. What, in your assessment, has been the biggest learning from the 2 decades of markets or deregulation and markets, gas markets in Europe? We can start with Baptiste.
Looking at comparing Europe, continental Europe, to the previous examples of the UK and the US, which are de facto independent in terms of their own supply, I think that one of the key findings from Europe is how you're able to set a functioning market that principally relies on importing its supply. And I think this is one of the key achievement that the continental market has done.
So yes, great. So even in a federated import-based setup, it is possible, and that's a great lesson for India, because we are pretty much halfway there. We import more than half our gas as of now. So we go to Dr. Laege. For you, what has been the most important learning?
The most important learning for me is that prices work and send the right signal. While this is a success story for the last 20 years, it's a warning for the next 20 years, because it needs stable environments so that that in the end, the investors take the price signals for serious. And I think that is what we now have to give to this sector to continue this, because if we don't, the trust is gone in prices, and then the signal is worth nothing. So that price signals work has been the biggest learning from my side.
Great story of integration of all stakeholders through prices and products which depend on the price differentiation, but then we need to hold on to those gains, and it's not going to be easy. Ilaria, to you, what has been the greatest gain? Listen.
I think that if we take a look to how policy and regulation have evolved in the course of the years, probably one lesson learned is that even ambitious targets, even ambitious policies should be embraced without too much fear. That sometimes it's very difficult to move from the status quo, which is reassuring, it's our safe zone, to new targets which seem very far away. It was the case for Europe in moving from monopolies to a completely liberalized market. It was a sort of jump in the dark, but slowly we are there, and the benefits are visible. And also I think we learned that energy markets can work extremely well and deliver, and that should always be the first choice. But there are also some targets, some targets that we want to achieve that do require at least some help from regulation, which doesn't have to be over-regulation, but some regulation can definitely help achieve targets that the markets do not manage to achieve.
Great. So have an ambition. Second is progress over perfection, and the third is a little helping hand from regulation. So those are great messages. Let me hand this over now after this fascinating discussion and the presentations back to Sumedha.
Yeah, before Sumedha, you come to conclusion, I think Mr. Kapoor also wanted to add his thoughts. So, sir, if you're there, we'll be happy to hear your thoughts on the today's discussions. I think he's not there. But okay. I also had one question, but anyway, now the time is up, so I will maybe seek answer later. The question was simple, that today you have entry-exit tariff, and you said one of the important component of the whole policy regime is transmission pricing, and entry-exit tariff is one of them. But generally in India, we believe that since we don't have very meshed network, so will that work in India or will it not work? Or is it possible there is any, or we need to keep whatever we have in terms of policy or tariff policy regime, where we have contract path method, zone-based, distance-based pricing? I'll leave that question with you all, and maybe later we can discuss. So
I think it's a candidate for your next Ignite workshop when you do that, because it's an ocean in itself.
Correct. So that's a very different subject, and it will take us another session like this.
Right.
So, Sumedha, I know that you would like to conclude, and I will go ahead with my concluding remarks. And it was really, we never thought that this will come to end, but it's so interesting discussion. I think more of this can happen over the next few months. Let us see how we can plan for that. So it was very insightful. Discussion was very insightful. A lot of queries I had, but somehow I'll keep it with me, and maybe later we discuss on that. So before we conclude, this would be definitely incomplete without thanking our chief guest, Shri Kapoor ji, for gracing this event and his presence and then insights. He has really shared his vision that finally everyone should have, the market should serve the basic purpose that everyone should have freedom. Everyone can choose what commodity he needs, and then today we have a lot of choices. In decarbonized world, you may need gas, you may need low carbonized gases, or you may need hydrogen, but a lot of choices will be there. All of that our market should provide. I also profusely thank our expert speakers, Mr. John Baptiste from International Energy Agency, Dr. Egbert, and then Ilaria. Lots of takeaway in this session. We heard Mr. Dubreuil on international scenario. That was wonderful. We talked about Europe mostly in later two discussions, and then we saw that complete deregulation took place in 10 years, and strong steps were taken. Most important step was third energy package, and basic pillars for that package was that you need to keep this market with the level playing field, and you have to think of competition, you have to keep non-discrimination at the basic article of faith, and then you need to create market mechanisms. And those who can develop better framework, as Ilaria said that if you are, or Mr. Dubreuil said that ETF progressed, and though the Netherlands is a small country with little, it's not the best in terms of import or with production, but still they could succeed in setting up a benchmark, which is actually a European benchmark. We also talked about entry-exit tariff. We talked about virtual trading points. So today still we have in Europe multiple trading points, multiple virtual hubs. But finally the dream is, or the goal is to have a one common European gas market. We have seen and we follow what in power the coupling has been done, the complete market coupling of European power market, and that is working out successfully. And also we heard about the crucial role exchanges played in the development of these markets by virtue of introducing transparency, liquidity, discovery of prices, and release of legacy contracts. And the most important conclusion which everyone was saying in unison was that markets will never disappoint you. Markets, if you allow them freedom to give price signal, they will give price signal, whether it's war or it's a normal situation. But whatever they do, that's true signal. It's not that there is some faking of the signals are happening. But only thing is you need to create the right market mechanisms. So thank you all, dear panelists, for elevating this discussion to a whole different level, through sharing of your insights, expertise, in-depth knowledge on your markets. And a lot of thanks to Anish for great insights. As always, you moderate so well and take discussions to a very different level. And it was wonderful to hear your thoughts also. Of course, more of that as we go further. Probably this IGNITE, you will remain part of the IGNITE, and we'll move maybe on quarterly basis to do a similar event along with you. So it's very evident from today's discussion that for its own growth, the nascent Indian gas market can learn a lot from the international markets, which evolved and progressed significantly through the years. And of course, in IGX also, we are seeing the growing volume. So this is also giving us confidence that the markets which we started working on is also working well, and hope to actually achieve or maybe help in achieving the vision of government to go from 6% to 15%, maybe not 15, but 10, whatever. But we definitely will add a lot of percentage to the gas-based economy. And IGNITE has not been possible, or because of has been possible only because of the efforts that has been put in by my colleagues at IGX, and big round of thanks to all of my colleagues for contribution and for making it success. And with this, I will conclude this edition of IGNITE. It was interesting for me to conceptualize and have most relevant speakers on the subject, and hope that will hugely add value to our understanding of the markets, and we will have a lot of takeaways. Hope this would have met expectations of our attendees also. And thank you all for attending. Take care and have a good day. Thank you.
Thank you. Bye.
Thank you, Mr. Rajesh Kumar Mendiratta, for proposing the vote of thanks. With this, we come to the end of this session, and I wish you all a great evening ahead. Please feel free to contact us at Team Practice in case you have any further queries. Stay safe.
Thank you.
Thank you so much.
Thanks.